Now, before we get into this one, we'd like to remind you, please like, share, subscribe. Hopefully this is helpful understanding and digging through some of the data that comes out on a daily basis and what does that mean going forward over the next few months. So now that we talked about kind of where we sat with some of the leading indicators, now we can look at what happened with retail sales in general. And you can see retail sales rebounded very strong in January. We had that new push of money coming in that obviously turned around, went right back into the consumer market. So what was the massive beat in terms of relations of what were the estimates? So the beat came in January, was up 5.3% month over month versus an expected 1.1%, which is versus the prior 1%. When we look at X auto and gas, we're up 6.1% versus an estimate of up 0.8%. And then the control group, which is I think more of the important side, was up 6% versus an estimate of 1%. So really a solid rebound across the board for levels and broader index. When we think about what does this mean going forward? Well, you had a new surge of capital coming into people's pockets that helped January get better. February has since slowed, but again, still a net positive in terms of where we are. We're still over where we were in January, which is, again, that net benefit. But this is something that is kind of that surge, and now we'll see how quickly we normalize. And if we look at how quickly that happened, the last time we had this stimulus, it was fairly quick. And now, what does that mean going forward? Well, based on it's a little bit smaller of a check depending on how you're receiving it, and you've been pulling from savings. So there's a certain amount of true up, and now I think we'll start to see kind of this deceleration of activity as we go through February and March. And why do I say that? Well, let's look at what is some of the expectations and unemployed adults, and what are they thinking about getting a job? And when we look at somewhat pessimistic, very pessimistic, about 49% are pessimistic about where do they think they're going to get their next job. And since they have been unemployed, they seriously considered changing their occupation or field of work. 66% said yes. So if you're entering into a new industry or a new line of work in general, you have to learn, the company's taking a bit more risk on you, so you're going to accept a slightly lower wage or maybe a sizably reduced wage. Again, these are things that are indicative of the wage compression that we're going to talk about in later segments. That is going to weigh on how much people can spend and how much of that money that you may be receiving in the mail goes into retail spending versus into savings as you try to get back on your feet in general. And then when we look at consumer credit and debit card spending, this is what we're talking about in general, where you can see that the stimulus payments from CARES Act, as you can see here, where it came in, and then the stimulus payments from the Consolidated Appropriations Act. So clearly, the money came through, and boom, it happened in credit card and consumer credit and debit card spending. Now, obviously, it happened at the lower and middle income levels, as we've been talking about, but it's because they're using that as much to purchase, because not only are you going to spend with credit because you're not going in the store, but you've just paid down your debt and you're going to pay down additional debt using that. So that frees up some of that credit card capacity. So there's really nothing surprising here. Obviously, the high income level remains weaker just because they're not getting the same type of stimulus, and their spending on the services side is reduced because low income is not sitting there going out and buying airline tickets and concert tickets and sporting events where the high income would. So again, that's where you're seeing some of that benefit when we talk about deflation. It's happening at the high income side where some of their stuff is going up, but some of the other components aren't. And we'll talk about that a bit more when we look at some of the increases in commodities. And this is just a deeper dive into what we're talking about on a real-time basis when we consider what has happened on the activity levels of spending. And when we look at where the payments start and where that movement is, we had that realization, and now this is an expectation of those declines as we got into the week ending January. And how does that view continue into Feb, which is something that we're going to talk about when we look at same-store sales. So this is where we have to pause for a minute and explain something, because when we look at the U.S. overnight rates, we have to think about where is this money going to go? Because when people are going to save the additional capacity, this is going to put pressure on some of these overnight rates. And as the overnight rates get pressured, the Fed is going to have to make adjustments, and we're starting to see some odd activity when we're looking at the overnight side. So the cash infusion ongoing in the Fed Treasury and MBS purchases is, again, shrinking that T-bill supply, and the drawdown of Treasury cash balance is going to have to prompt the Fed to proceed with some adjustments with the interest on reserves and the excess, or the interest on excess reserves. So the IOER and then the RRP, which is the overnight reverse repurchases, are going to have to be adjusted to provide a place to put some of this capital. Because when we think about the overnight, you're getting pressure on some of these short-term rates, and the pressure on the rates, as you can see, as they've come under pressure so far in 2021. And that's with the additional money moving into savings. That's the additional money moving into money markets, which is going to cause some of the banks to limit what institutions can put in their into their overnight market, because the banks themselves have less volume to buy in T-bills that are going to provide a stable overnight rate as the Fed pulls more of those treasury bills out of the market, leaving some of the long dated. But because you're in overnight level, and for someone who worked in repo for a time, you can't go out more than 366 days. So you have to have a balanced approach of what you own, which is just overnight, where you're buying it in overnight, then it's going to settle. Things that are going to be a month out, 2 months out, and then a maximum of essentially a year. And with the shrinking of that availability, you're losing the safe, if you want to say, safe place to put this capital and get it back the next day. So again, that is pushing rates further, because the competition is increasing, pushes the prices up. And remember, price and interest are inverse. So as prices go up, rates come down. And that's where we're starting to see this additional issue that is coming in, which is going to make the Fed take action, which is something that we're going to talk about in a minute with the multiplier effect, and what does that mean depending on how we define multiplier effect. So then when we look at the PPI, again, thinking about where things are on the inflation side, because you have money coming in, you have people spending. Well, the producer purchase index, when we look at, was much stronger. And again, prices paid, prices received. We keep talking about this, even though I'm told I'm crazy. Came in much stronger than expected at 1.7% year over year versus 0.9% estimate and 0.8% in prior months. Ex food and energy is the orange, which is up 2%. And then once we factor that versus year over year on an estimate of 1.1%. So again, we're starting to see this increase go back up. And it's, if you just look at this and then look at the 30-year and just the movements in general, you're seeing where we're getting that pull, essentially pulling those rates higher. As we're starting to see this PPI increasing, that means that you're going to see that show up in pricing. How much of that can be passed through is always going to be an issue, which is why we look at prices received and prices paid. So prices paid is what the company is buying things for, and then what they're charging their customers with. So as this widens, this is going to compress margins. And based on obviously there's still a high amount of competition in the market. Retail sales are up, but lumpy in general. You can't push through all of these price increases, because then people are going to go away. So it's this weird balancing act that they're trying to maintain, but more of this prices paid is going to show up in prices received. But again, how fast and how much is going to be indicative of what does the company's margins look like in general. And just looking at this, the Empire prices received, again, talking about the Empire index that came out earlier, you can see where the prices received are in that PCE year over year, which is why we keep talking about there's going to be that shift up as we think about the personal consumption index, the personal wealth, and what does that mean for inflation, and how is that going to reverberate through the system. Now, as all of this is transpiring, people are looking to find more yield. And that's where, again, if you can't get it on the front end, you're going to go down that riskier scale. And U.S. corporate bond issuance is CCC rated or lower. You can see that these guys have been hitting the market aggressively, and there's been buyers of this debt because no one has anywhere to go. The rates are too low on treasuries. Investment grade is essentially a knife fight over minuscule basis point spreads. So then you go further and further into the high yield, and based on the demand for that paper, you're seeing companies take advantage of that and issue that debt. So again, this is coming to where does this bond bubble start to become a bit of a problem? Well, this is it. And this is where we continue to see of how long can this last before there's pressure in the system in general. And then when we think about, okay, well, let's look at Redbook Index same-store sales on the weekly side year over year. So now it's at its lowest since September of 2020. And this is an important component when we think about the weekly capacity. So you can see here that we registered that big spike. So we saw that spike, which was built into the retail sales. Retail sales exploded to the upside. We saw that. That was January. This picked up January as we've been talking about the Johnson Redbook Index. But now we're below where we were in January, and where January started, where December ended, January started. And this is going to then show up of, well, how much of this can be made up through the remainder of Feb to maybe mitigate some of the decline in the spending in general on the consumer level. So when we think about what are people doing with their time, this is something we have to weigh on work from home, because work from home, people are still not going back to the office, even though there's been some adjustments in the market with getting closer to herd immunity. People are still not going to the office. And how are people using their time? Now, I know personally, as someone who went from commuting into the city to commuting 10 minutes to an office that you see on screen, I picked up an extra hour and almost 2 hours in an available working time by not commuting. Now, I try to do things with my commute time, but that is also showing up here where people are working longer hours because there's more hours that they can use. Now, obviously, childcare becomes a bigger issue, which is that bifurcation between male and female. Some of the hours have been pulled away, especially as we've had online learning, which for anybody who has been doing online learning, you should seek sainthood, because online learning with children is brutal, horrible, and we love our children. I have 3 of them, but as my wife said, if she had to deal with online learning for more than 2 weeks, because my oldest was home for 2 weeks with online, she's like, I'm pretty sure I would just drive her to the school and leave her at the doorsteps. So this is obviously a big overhang for some. And then that's obviously becoming that bigger issue of how do we weigh the differences or the two between working and childcare, which is why work from home will have a bit more longevity in this world, in this next iteration of the future. Now, this is just rehashing how good the state manufacturing survey was on general business conditions. Here you can see that strong recovery. The issue is number of employees still remains strong, but started to normalize a bit again, which is where we get this concerning aspect, because while the Empire State Index has been pretty good, other components of central bank, or I should say Fed data points, depending on region, have come down. This is where employees, jobs, wages, unemployment becomes the bigger overarching theme that we've really been highlighting as a problem from the beginning of COVID in general. And really, at the end of 2019, this is where we were focusing the most. So headline came in at 12.1% versus 6% of the estimate, and that's 3.5% in prior months. New orders, hours worked, 6-month business expectation, and prices paid all higher. Employment remaining strong as well. But when we think about how are people going to be impacted on different levels, and this is where we're gonna pivot for a minute and talk about cars and what is, and just using cars as an example, because we've seen depreciation in technology. Because let's just use round numbers. So let's say 10 years ago, a gigabyte of storage was $1. I mean, now a gigabyte of storage is like 5 cents. You know, we're talking about sheer drops over a 10-year period. And again, that honestly, like the price was probably lower and price is probably actually where it is now. But again, how much further are we going to fall given the increase in tin, the shortage of semiconductors, the increase in quartz pricing, silica pricing, lithium pricing, copper pricing? All of these commodities have seen an explosion due to supply chain issues, but also the increase of complexity of the semiconductors and the increase of usage of electronics. I mean, anybody that had a car that has a car that's 15 years old knows that the electronics in that car is not what an electronics is in a car that was made in 2020, 2021. So what you're just seeing an additional absorption of semiconductor computing capacity into more and more of our daily lives. And those fab facilities, you know, we talked about it last year when we did the whole the whole breakdown of fab versus foundry versus production testing. You know, there is a shortfall because those facilities cost a lot of money. Taiwan Semiconductor built one for $6 billion, took 3 years. As we put more transistors and activity on these chips, the estimate that over the next 10 years, a next foundry is going to cost $20 billion and take 5 years to build. Again, these are things that are becoming a bigger problem. And the exposure to industries using electronic components, you can see just the share of GDP, which is why when we think about GDP growth, how much of it will be lost because of motor vehicles, electronics, electronic equipment, machinery, other pieces that are using these electronic components. I mean, South Korea, Germany, Japan, China rely so much on this computing capacity, and the shortfalls are now sizable. Commodity prices have gone up, and there's this shortfall. So how much can China, for an example, subsidize their exports to protect their market share in that world without some things getting much worse in general? And this is just looking at the share of car manufacturing, just to kind of put it in perspective. Obviously, Mexico, Germany, but then when we look over into South Korea, Japan, China, into other parts of Vietnam, India, there is Mexico. A lot of GDP is going to be generated from this car manufacturing. And now we all know Volkswagen, Toyota, Ford, GM have had to slow production due to shortages of chips. And they've been asking these guys to increase their production. But again, what's the incentive? Because the margins are lower on a car semiconductor versus a computer, laptop, cell phone semiconductor. So again, there's going to be this kind of weighting aspect. And what could be that hit? Well, the auto industry may lose $61 billion of 2021 sales due to those chip shortages. And again, you can see China is that largest side of pain, and which we continue to talk about. We'll talk about it again in the last segment of how can they maintain their GDP estimates given the impacts that they're going to see two different parts of their economy. Then when we look at that a little bit differently, as we see more cars, more people driving, as we talked about last week and the week before, if you bought a home in March, you probably bought a car in April. If you bought a house in April, you probably bought a car in May. So there's more cars and there's more trucks on the road. And for anyone that's been in the market today or yesterday or over the last week, gasoline prices continue to go up. Now with the issues in Texas that we highlighted in segment 1, the issues that we're seeing in general, those prices are going to shift higher over the next few days as we see RBOB going up. As I said on Bloomberg television, short oil, long gasoline was going to be the play, and it's played out. And this is going to pull up, but what is that going to do? That's going to increase inflation because you have a base effect in gasoline prices, and just gasoline prices are going up in general. Again, inflation. So when we look at that multiplier effect, we have to think about what is happening with this money going into into the bank. So when a customer, so there's two ways to look at this. So when a customer makes a deposit into a short-term deposit account, which is why we were talking about the Fed issue, the banking institution can lend one minus the reserve requirement to someone else because the Fed requires money to stay on your balance sheet. While the original depositor maintains ownership of their whole amount, the funds created through lending are generated based on those funds. And then if a second borrower subsequently deposits funds received from the lending institution, you continue to see the value of money supply moving through the system. Now, when we look at that multiplier effect, you can see it's been very negative and continues to move negative over the last, let's just say 2 years. And it's because banks have been lending less. Let's think about why. I have interest rates going down, so I can't lend at the rate I want to make money and cover a bad debt expense. Or I can buy T-bills and then sell them to the Fed at a premium and capture a guaranteed spread. It's a no-brainer. They're going to capture that guaranteed spread, not lend as much, especially because they have an increasing bad debt expense, because the bad debt expense has been ratcheted up over the last 4 quarters, which is keeping more cash on the balance sheet. So you're keeping more cash, which means that you're investing less, which means that you're not moving that money to number 2. So you're taking someone's $100, and instead of lending 90, you're keeping the 100. You're then using that to secure bad debt expense by keeping cash on the balance sheet, not lending, and then playing the spread between the two. That's one way to look at it. Another way is a company makes a $100,000 investment of capital to expand its manufacturing facility in order to produce more and sell more. After a year of production with the new facility operating at maximum capacity, the company's income increased by $200,000. This means that the multiplier effect was 2. Simply put, for every dollar of investment, it produced $2 of income. What have we not had over the last 10 years? That. People have not been investing in stuff. They've been using the financial manipulation of, I'm going to issue debt, buy back stock. So I'm going to leverage my balance sheet. I'm going to borrow $100,000 to then buy $100,000 worth of debt, worth of stock. I'm not creating anything or generating a multiplier by increasing my capacity. This is where we've seen this breakdown, because as a bank, why am I going to lend to someone at a certain point that's just leveraging their balance sheet and creating no value on the other side, or I don't have any actual collateral to go against? And this is where we continue to see that play out. But with all of this happening, we are getting an increase in inflation. And this is just kind of highlighting everything that we've talked about with what's been more affordable and what's been more expensive. So, here you can see wages, the overall inflation of 55.6%. But what are we seeing changing? Well, new cars, those have gotten more expensive over the last year. Households, guess what's household furnishing has gotten more expensive. Clothing, cotton prices are going limit up. Cell phone service, we're starting to see some of those moves higher as costs of hardware is getting more expensive. Software, something similar. Toys are still free. TVs, smart TVs, you're starting to see, again, those increases where people that have maybe gone out to try to buy a Samsung are finding there aren't any Samsungs, and the Samsung you can get is costing you more. So again, all of these things are starting to push up because this is only through 2017. Again, inflation is not only being driven by the top end, but is also now being driven. What used to be more affordable is now turning back up as prices are increasing. And this is why we look at the federal budget outlay and the M2 multiplier, because the federal budget continues to increase in what they're putting out into the market. And this is weighing on that total multiplier because you're just getting so much cash that the Fed is buying and trying to move around that we're just not, and manage rates in general, that we're just not seeing that turnover. And this is where we start looking at what has happened on that copper to gold ratio versus the 10-year Treasury yield. Again, 10-year Treasury is going in one direction, inflation indicative, seeing these rates, and we continue to think that rates will start to pull out some of the air that is in this equity market. Because what is happening with the Fed Treasury holdings? Here you can see the growth of that. It's just funny when you start putting these numbers together. When you can see just what law of diminishing returns means in 2020, as they essentially increased the holdings level from 2009 to 2013, tried to decline into 2019, had to immediately reverse in September, as we have been talking about with the issue with repo, which is why we focus so much on it in the Shibor. And here you can see just the law of diminishing returns kicking in and the Fed needing to issue more than the original because they have to put more in to get the same base effect due to the law of diminishing returns. And that is causing what? Well, let's look at steel prices. U.S. steel prices have more than doubled in under 6 months. While Shanghai has a hot rolled coils continues to be on $1 per ton because obviously the dollar has weakened, so that has mitigated some of this. But again, when we look at what has happened in China, we've seen their margin compression. We've seen additional capacity problems, which is mitigating and hurting some of those capacity within the Chinese market. And when we look at tin, biggest backwardation, spot tin spiked to trade at the largest premium to futures in decades. Again, spot pricing, we're seeing this tightness. This is Myanmar because tin comes from Myanmar. Then you have other issues in terms of where are people buying stuff in general. And this is where the shortfall and the expense on the semiconductor side is coming back into play. Then what do we see with Chinese Lunar New Year? So holiday public transport remains down 76% from 2019 and 2020. This is one of the reasons why and we'll touch on this more in the EIA show, you're seeing less activity happening in China in general as nobody's using public transport still. So that's taking away some of this capacity that came in 2020. And we already have driving, we have airlines, all of that is coming down at a very steep level, which is, again, putting those pressure into the market in general. So then when we look at the Dallas Fed, you can see the mobilities have come down overall based on the different states. The early outbreak states have seen this continued decline of, what is the percentage of late outbreak states have started to normalize. You see kind of that national level that has been following this fairly stable spread between that down 60 to 65%. But when we look at early outbreak states, that remains a problem. Other states. So again, there's still some normalization happening, but you can see that we're starting to get that slowdown. And as these two converge, it's the early outbreak stage states that are starting to converge up as we get some normalization in restaurants and just activity in general. But then when we start to factor that in with delinquent rates, what are people doing with their money? Here you can see the delinquent rate by loan type. FHA loans continue to be at the high level. Some of this has pared back, but this is going to become a bigger problem when we look out at what is what is going to happen on inflation and what happens when some of this normalcy comes into the market, when we're starting to talk about what happens on a go-forward level with delinquencies, bankruptcies, and evictions. So then here, when we look at that break-even inflation rate, guess what? It's going up. Fiscal monetary reflation is up and out. We're now above where we were in going back to 2020, back through 2017. This is the 5 and 10-year break-even inflation rates that are going up and out, which again is going to hurt some of this normalcy and activity that we continue to talk about. And then when we look at goods prices are sensitive to the dollar, the dollar is starting to go up as we have the bid going up at this point in time. And then we'll just highlight what the 20-year came in because it just printed. And then when we look at, again, looking at that 5-year U.S. break-even inflation rate, we're now at 2.32%. It's actually higher right now. And it's coming into right around that 2.34%, which is why when we look at U.S. consumer sentiment, it continues to fall. Even though we're getting some of this normalcy in the market, the consumer still feels the pain from this inflation that we continue to discuss, which again is also showing an income gain cited for improved personal finances. So you're seeing some of these income gains on the income bottom third, income middle third, income top third. The top third has gotten better while middle and lower third continues to get worse. Again, the income gains cited for improved personal finances continues to be bifurcated of top tier is okay and getting better. Lower is getting worse, which is why we see this bifurcation in that consumer level, which is only going to make rates and things it's going to weigh on what is the consumer going to do and what is GDP going to do over the next few months.